Have you ever asked yourself why traders who operate with hundreds of millions of dollars never seem as tense as you are? They don't hold losing positions in pain. They don't pray. They don't go all in on a single trade, hoping to double an account overnight. So what do? The answer is simple. They are not playing the same game you are playing. They participate in the same market, but they live in a completely different world. And that's why they survive and win. I once asked a friend who works at an investment fund in Singapore, someone who directly manages over $200 million just in Forex and gold. I asked him, "Have you ever entered a trade and couldn't sleep? Have you ever sat there watching every single candle because you were too anxious?" He smiled, a very calm smile. And then he said, "If I had to worry like that, I would have been fired a long time ago." That's the first difference. Retail traders bet with emotions. Funds bet with systems. Retail traders play a game of winning and losing. Funds play a game of probability and risk management. Every day, thousands of traders out there open MT4, MT5, TradingView. They use $100 to dream of 1,000. They use 1 to 500 leverage to chase the news, and then they wonder why, after just a few hours, their accounts are gone. Meanwhile, on the other side of the market, funds operate like machines. They don't care what hot news is trending today on Forex Factory. They track capital flows, macro trends, currency wars, Fed policy, and the movement of global capital. They enter trades not because the chart looks good, but because the trade fits into an entire system that has been validated across thousands of executions. If you have a $1,000 account and you enter a trade with 0.5 lot, a 20-pip stop loss, risking $100, you are risking 10% just to chase a dream. But with a $10 million account, no one risks $1 million just because price broke a trend line. That's why this video won't teach you short-term trading tricks. It won't teach you how to draw RSI or memorize candlestick patterns. This is about how people who truly trade with large accounts manage risk, run systems, and survive through every market cycle. A world where emotion is removed. A world where money is no longer a game, but a strategic machine that operates like an army. And if you truly understand that world, you will never trade the same way again. If you've ever dreamed of one day becoming an independent trader, living off other people's capital, or turning yourself into a one-man investment fund, listen carefully. Because in this video, I'll show you how large funds manage accounts, how they enter trades, and why being right just a few times a year is still enough to win an entire cycle. Ready? Let's begin. Why is it that some people make money while others don't? Ray Dalio, a name even Wall Street respects, didn't start out any differently from many ordinary traders. A small office, barely bigger than a living room, no large team, no advanced technology, just determination, a mind steady enough to endure, and a notebook where every trade was recorded, every mistake, every lesson paid with sweat and blood. He wasn't a genius. There were mistakes so serious that Bridgewater Associates, the fund he founded, nearly didn't survive. But instead of quitting, he asked himself, "Where did I go wrong? What thinking framework led me to make that decision, and how do I make sure I never repeat that mistake again?" The answer didn't come from staring at more charts. It didn't come from predicting whether price would go up or down. It came from building a system of principles that could not be broken, a system that could operate independently of emotion, and eventually, a system others could run in his place. That is how a trader becomes a fund founder, and how a fund founder becomes a legend. And what about George Soros?
People remember him for breaking the British pound in 1992, but very few remember that before he dared to place $1 billion on a single trade, he spent years simply observing crowd behavior and responding with inverse logic. He didn't make money because his analysis was always right. He made money because he identified where the market was wrong and acted decisively while the majority was still hesitating. In an interview, he once said something like this: "I don't care whether I'm right or wrong. I only care how much I make when I'm right and how much I lose when I'm wrong." That is the foundation of large account thinking. You don't need to win every trade. You only need to be right a few times with positions large enough. And most importantly, you must not allow yourself to be taken out of the game before the real opportunity appears. And there are many other names. Paul Tudor Jones, a man who can cut losses without blinking even after a long winning streak. Stanley Druckenmiller, who once said, "Trading is the art of controlling greed and transferring risk to those who come later." They weren't born knowing how to manage hundreds of millions of dollars. They learned through failure. And more than anything, they turned themselves into systems, not gamblers in the market, but living embodiments of strategy. You may start with just $1,000, but if you think like someone managing $100 million, you are on the right path. If you trade as if you're gambling, then no matter how much money you have, sooner or later it will all dissolve, candle by candle. Before we move to a new part, I want to say thank you. Thank you to those of you still listening this far. This channel was born from a simple belief. Trading is not just numbers and signals. It is a journey of intelligence, mental strength, and transformation of thinking. If you're still here, you are not like the majority. You don't just want to win, you want to understand the game and control it. Thank you for being here, and this journey has only just begun. Most retail traders carry a dangerous illusion. To win big, you must be right all the time. You must catch the top. You must buy the bottom. You must stay one step ahead of the market. But large funds don't think that way. They don't need to be right often.
They need only one thing: not to be taken out of the game. For them, trading is not a casino. It's a military campaign. Every decision has a clearly defined risk limit. Every 1% of capital is allocated with intent, and survival always comes before winning. Did you know that many of the world's top trading funds have win rates of only around 40 to 50%? That means they're wrong almost half the time. But when they are right, the profits they make are 3, 5, sometimes even 10 times their average loss, and that is enough. Enough to win consistently, enough to stay in the game for the long run. So how do they do it? They think about risk before they think about profit. Before every trade, the first question is not, how much can I make? It is, if I'm wrong, how much will I lose? And will that loss damage the entire system? The answer must always be no. A losing trade is never allowed to harm the whole account. An emotional decision is never allowed to override principles. So instead of dreaming about a trade that could double the account, they look for opportunities with reasonable probability and controlled risk. No glamour, no drama. Just clear logic that can be measured. They understand something most outsiders never realize. In trading, not being taken out of the game is more important than winning small trades. Because real opportunities, major swings, unexpected macro moves, large market mistakes, only appear a few times a year. If you're still around when they happen, you can win big. But if you've already blown your account on small trades before that, you no longer get to participate. That's why large funds are extremely patient. They can wait weeks, even months, just to enter a single position.
They ignore market noise, unimportant news, liquidity traps designed to lure traders in. Because they understand this: to win big, you must first learn how to stand still. And when the moment comes, they act very fast. No shaking hands, no hesitation. Not because they're reckless, but because they prepared long before. They don't react emotionally, they simply activate a plan that has been built over time, with a risk-reward ratio calculated precisely down to the last pip. That is the mindset of large funds. Calm, disciplined, minimal. They don't need to be right often, they just need not to die. I still remember clearly the first day my mentor introduced me to the real world of trading, not in front of a computer screen, but inside a meeting room. There, people didn't talk about perfect entries or candlestick patterns. They talked about capital, about probability, about maximum drawdown allowed in a month, and about how to keep an account alive even when the market goes insane. My mentor looked at me and asked, "Do you think getting rich from trading is about good analysis?" I nodded. He shook his head. "No, it's about keeping yourself from being killed by the market while you're still learning how to become better. It's about learning how not to die stupidly." I stayed silent. Because deep down, I know I've died stupidly before. Died because of greed. Died because of the blind belief that I was right. Died because of the illusion that just a few winning trades would make the account bloom on its own. But my mentor never taught me to become the best. He taught me to become someone who still exists. Because when you still exist, you still have choices. But if a single trade destroys your entire account, you have no rights left. Not even the right to fix your mistakes. Large funds understand this. My mentor understood this. And after many years, I finally began to understand it too. Sometimes you see someone change their life with just one trade. You admire them, you envy them, but you don't see that before that trade, they went through hundreds of days doing nothing, just observing, just writing things down, just waiting. Like a hunter who never takes his eyes off the prey, but won't pull the trigger until he's certain one shot is enough. And that is the difference. Amateur traders look for opportunities every day. Professional traders look only for the right moment. I call it the art of deliberate silence, a form of discipline at the highest level. Because only when you don't need to trade just to feel like you're doing something do you truly control the game. That's when I understood why large funds can sit still during days of violent market swings, why they are patient, why they are not tempted by small waves, and why they win. Not because they're always right, but because they live longer than everyone who always wants to be right. The problem is not how much money you have, it's how you treat that money. Do you manage it like someone entrusted with responsibility, or do you spend it like someone gambling their last chance? When your mindset changes, your behavior changes, and the results change with it. So how is a large account actually managed? With what strategy, what structure, what way of thinking so that it doesn't just survive, but grows sustainably? The answer lies in the way top trading funds run their systems, something I once believed existed only in books until I lived inside it. There are no shortcuts to sustainability in trading, only systems, only principles, and only discipline repeated to the point of stubbornness. Large accounts don't exist because of luck. They are protected, coordinated, and built like a business. A trader who behaves like the owner of a trading business is no different than a CEO running a company worth hundreds of millions of dollars. And every sustainable business has a foundation. In trading, that foundation is built on 5 pillars. The first pillar, position layering, never entering with a single order. Funds never go all in with one click. They divide positions into layers. The first layer, probing, small, willing to be wrong. The second layer, confirmation, scaling up when the trend is reinforced. The third layer, reinforcement, adding only when the market behaves according to the scenario. And if things move against them, they exit layer by layer, reducing damage, not drowning the entire account.
That's how you survive. Never put everything into a single strike. Every move must have a way out. The second pillar, risk management through probability, not emotion. Amateur traders guess price. Funds calculate probability. Every scenario is modeled, its frequency in the past, its volatility, where capital flows are positioned. They don't ask, where do I think price will go? They ask, how many times has this pattern occurred and what is the success rate? Every trade has a specific risk number, usually below 1% of the account. No matter how confident you feel, that trade is never allowed to exceed the limit. No breaking limits, no breaking principles, no gambling. The third pillar, multi-asset capital allocation. Never put everything into one basket. Retail traders often tie themselves to a single pair, a familiar instrument, EURUSD, gold, or a favorite stock. But large funds don't operate that way. They allocate capital across asset classes, currencies, commodities, bonds, equities, safe havens, and even hedging strategies. Not to trade more, but to choose the right battlefield. Because not every market creates opportunity all the time, and no strategy works in every environment. The fourth pillar, psychology and systems. Never let the human destroy the machine. Professional funds don't rely on personal emotion. They build systems. They journal every trade. They assess psychological state on a weekly basis. And they use technology to monitor the gap between actual behavior and predefined principles. When a trader begins entering trades without logic or increasing size without reason, the system flags it. No one is allowed to break discipline, not even the founder. In trading, the most dangerous enemy is not the market, it's yourself. The fifth pillar, regular audits. Even when you're right, you audit. Even when you win, you scrutinize. Large accounts do not allow intuition to dominate. Even in profit, they review. Why did we win? Was it the system or just luck? Was there any behavior outside the standard? You don't need anyone to supervise you. You are the control board. You are the investment committee. And you are also the one who decides whether you still deserve to manage this account. The last thing you must never forget, the way you treat $500 today will determine how you'll be trusted with $500,000 tomorrow. The market doesn't care whether you're trading a demo account or a live account. It doesn't care whether you trade small or big. It responds to only one thing. Are you behaving like someone who can be trusted? When every day you enter the market with the mindset of sitting in the strategy room of an investment fund, when you no longer tremble from losses and you no longer get intoxicated by wins, when you can sit in front of the chart and do nothing, simply waiting for the right moment, at that point, you are no longer a retail trader. You have become a system, a strategy with awareness. An investment fund with your own name on it. Beginners in trading look for strategies. Those who survive a few market cycles start looking for systems. And those who go very far, they look for themselves. Trading is not a competition of analysis, not a game of predicting trends, and not a place to prove you're smarter than others. It is a mirror that reflects clearly your discipline, your impatience, your greed, your fear, and your ego, with no mercy, with nothing hidden. Warren Buffett once said, "Rule number 1 is don't lose money. Rule number 2 is never forget rule number 1." It sounds simple, but to actually live this way, you must accept missing many opportunities that others find irresistible. You must dare to stay out when the crowd is intoxicated. You must hold cash when the market looks almost certain to go up. And you must stay clear-headed not only when you lose, but also when you're winning. George Soros didn't build his speculative empire by always being right. He built it on the ability to reverse. "I became rich by knowing when I was wrong," he once said. What matters is not how many times you're right, it's how much you make when you're right, and how much you lose when you're wrong. He never tried to win every trade. He waited for rare moments when the market revealed its mistake clearly. Paul Tudor Jones was disciplined to the point of coldness. He once said, "I always think about how much I can lose before I think about how much I can make." He cut losses very early, even when it felt like the market might come back, because he didn't trade on hope, he traded on principles. He even built monitoring systems just to watch his own behavior, to guard against moments when the ego tried to take control. 3 people, 3 peaks, 3 different paths, but they meet at one common point: humility before the market, ruthlessness toward the ego, and absolute discipline with strategy. The lesson here is not to copy them, because you are not them. Your account is different, your personality is different, your life is different. But there is one thing you can absolutely learn. Whether you're managing $500 or $500 million, the final winner is not the smartest person, nor the best analyst. It is the one who can control himself the longest. The market doesn't need you to be great. It only needs you not to destroy yourself. You don't need to be right every day. You only need not to fall halfway through. If you've made it this far, you may be standing at a crossroads. One path is the old way, emotion, luck, no system. The other is the new way, thinking like a fund, acting like a professional, and surviving long enough for the market to respect you. No one forces you to choose, but if you do choose and truly commit, everything will change. Not just your account, but who you are. If you need a sign that you're on the right path, this is it. You're no longer a gambler. You're becoming the operator of a machine built to survive and generate profit, not based on luck, only on discipline and principles. You don't need to tell anyone that you've changed. You don't need to prove that you're more disciplined, more professional. Just stay silent and start behaving like an investment fund. Every time you open a chart, ask yourself, if this were a $10 million account, would I take this trade? If this were investors' capital, would I dare to risk it? If I were the one responsible for the entire system, do I have enough reason to act? If the answer isn't clear enough, do nothing. Because a good trader is not the one who knows the most, it's the one who knows when to stay still. In the end, trading is not just a skill, it is your nature reflected through every small decision. When you control yourself, the account follows, the market follows, the results follow.
You don't need to be faster than anyone else. You only need to be more consistent than the version of yourself from yesterday. If you're in the middle of that journey, from an ordinary person to a solid, reliable system, leave a comment below. It doesn't have to be long, just one sentence. I'm starting. It's a quiet commitment, but a heavy one, to yourself, to the path you've chosen, and to those growing alongside you. If you found this video valuable, subscribe to the channel, not to watch more, but to go deeper. Because this place is not just about trading, it's about how you become the most grounded version of yourself, in the market and in life. Thank you for staying till the very end, and if you're truly serious, remember this: the road ahead has only just begun.